All right, good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for October 1st, 2022. Saturday night swing trade review edition. Welcome aboard. Nice to meet Geraldine, new subscriber to, I think it was the Swing Systems. So, welcome aboard.
Thank you.
Um, so, before I go into the charts, I want to back up and just hit a uh, quick quick overview of our swing trading. It'll probably benefit everybody. So we have a number of swing trade approaches. I'm going to describe some right now. Let's see, brush. Let's see if I can get this rascal to work. All right. So in general, when we're thinking swing trades, um, we place that in a position between core trading and day trading. So in terms of time frames, and we think about core trading as positions that are going to last like anywhere from 2 weeks until forever. And day trading, obviously, intraday only. And so swing trades tend to be trades that last from 2 days, maybe to 10 days, right? So we're thinking 2 days to 10 days. And we can think of those three styles of trading or those three time frames of trading as separate and distinct bodies of knowledge that really have different purposes and different approaches and different time commitments and different objectives, and performance factors are going to be really different depending on which bucket that you're in. So when we think about the core, we think about things like the monthly asset allocation of blended monthly rebalancing. We can think about an even more relaxed approach, which is asset allocation uh, with a balance between, say, stocks and bonds or ETFs and bonds, uh, with or without a market timing scheme, so that if you are in the bull market, you're just long and strong with some kind of blended mix that's appropriate. As you approach sideways or bear markets, you may take some of that money off the table as a way to reduce volatility and to prevent against total catastrophe. You might use something like the Brown Permanent Portfolio, which is a mix of short term interest generating bonds, long term treasuries, excuse me, gold, and the S&P 500, for example, or total market index. And it just rebalances continuously, always in the market. So in the core, what you're really looking at is simply you're watching the corn grow. You're trying to drive, or you're trying to plant the corn during the right season and just let it grow, or uh, go fishing during fishing season, something like that. So you're not really trying to optimize. You're trying to get market returns. Hopefully, you can get um, uh, an improvement on risk. Hard to get improvement on reward unless you're doing something like the BMR, which is rotating into relative strength winners. At the other end of the spectrum, on the intraday trade, what we're really doing, and you see us doing this a lot most of the day, the most of the days of the week, and the forex guys and the nightly podcast. We're doing mostly intraday trading. Um, and we really don't talk that much about the swing trades that could be going on, because we're really managing the intraday bucket. And what we're trying to do there is eliminate the overnight risk in equities and take advantage of statistically valid patterns that take advantage of abnormal conditions and then play for either a continuation of the abnormality or a reversion to the mean. So in a nutshell, what that looks like is if you had some kind of price action like this, and then you had some kind of threshold in which you would say this between those two prices is normal. What we're looking for is something like a move that goes out of normal and then comes into a relative range compression, which we would call in general a critical state. And then we think that critical state is either going to resolve itself back to the previous normal, so that's a reversion to the mean trade, or we would say there is some kind of underlying factors in the market that caused it to have that abnormal move that brought it down to this critical state, and then maybe that's just the first leg, and we might be expecting to see 2 or maybe 3 more legs as the market discovers whatever it was that was causing that problem. The other kind of day trade we get is when that range of normal compresses to such a narrow degree that you have an abnormal compression. And we think, well, that's so abnormal that that itself is a critical state. And then we play something like a bracket trade or a Z3P where we're looking for the breakout in either direction. And we're actually ready for a fake 1 and go 2, or we're ready for that thing to continue to fail. So the day trading tends to be statistically based. We're not looking for deep-seated reasons for the price action to occur. Like, we're not trying to find some explanation that triggered it. We're just saying the price action itself is its own explanation. And what we're going to do is recognize when we have normal conditions and what we can do inside of normal conditions. Like inside of a normal condition, for example, you could play these kinds of moves, which I'm showing in the green, where it comes down to the boundary of normal, and then it reverses through the mean and then goes to the far side of normal. And so you're just getting this kind of intraday channeling. And it may be that in that kind of a market, you can have small risk boxes like that at the boundary. And then what you said is, look, if that thing fails and goes this way, goes south, then it just violated the boundary of normal, and so I'm into my abnormal breakout move, and I only have to pay that tiny little risk. But if it works and it goes up from here, then I get a favorable reward to risk multiple if it just goes to the other limit of normal. I might get 2 or 3 or 4R in that kind of case. And then when it gets to the far side, it's in another critical state where it's either going to revert back to the mean, or it itself might break out and become abnormal. So that in general represents the standard frame of mind that we adopt intraday for using statistics in our favor, not having a directional bias, but really taking a look at the market structure and looking for the different levels of support and resistance. So the resistance above, and then say the support below, and then we're watching for that price action to come down and find support, hold, and then we trade it, and we're looking to get back to the first level of resistance. And if it starts to fail, we invoke the 2-hour battle drill and it wins. But if it continues, then we think it can get to the second level of resistance. And if that fails, we think we can do the 2-hour battle drill and get paid. Or if it gets to the third level of resistance and starts to fail, we can cash a really good trade. But then if it breaks out of those limits of normal resistance, that's when you really start getting that abnormal condition, which might represent that runaway freight train. And so we play that in both directions. So that is a very different proposition than the core. In the core, what we're looking at is the non-correlated positions to get some diversification. We're trying to find relative strength winners with a belief that winners are going to continue to win until there's a significant slowdown. And we're going to try to just generally concentrate on the strongest sectors while they're continuing to be strong. So what that leaves us now is that middle space in the swing, which is it's going to take some of the elements of both of those bodies of knowledge to help us with the swing. So with the swing trade pattern, there's really these different approaches here, and I want to cover them. So the mechanical systems are 6 patterns, 6 robotically tradable systems, like the 5-day down, the washout, the triple screen, the 551W. I'm trying to remember the other one. Oh yeah, overreaction and channeling. So that gives you 6 standard systems that we've been trading for more than 20 years, each one of which has a very particular theory of action behind it, why it should work and why it does work. And it typically has holding periods from 3 to 5 days when they work. And you might get anywhere from 5 to 8% of performance when it's in that, when it's working. So there are very specific symbols we trade. There's criteria for the setup and the stalking and the entry and the position sizing. And then you get a standard histogram of results of that thing, which allows you to manage your position sizing and your frequency and to refine your pattern. So these are all well known in our community, I suppose, I hope. You can trade them robotically. And in fact, we know that because we have a TradeStation trade assistant that lets us do that. You can do it in TC2000 as well. Now, the other thing that we have on those is that we have an add-on module called the continuation pattern. And what we discovered was that a lot of times these patterns, like the 5-day down, will look like you have some kind of bullish pattern, a bullish market that has gone up and then has 5 days down. And then we put a little trade box around this thing and we say for execution, we are ready to go long if it breaks out from the highest high of the previous setup day. And our first target is like to the top of the swing high or the 10-day high. We typically use the 10-day high as the price target that would not be reasonable because 10 days is kind of the standard longest swing trade we normally experience. So we go find the 10-day high and we say if this anomaly, this 5 days down in a row, is something like an overreaction, and then people are going to see that, hey, this is a great symbol and it is sold off 5 days in a row, that's got to be an overreaction. So they're going to start coming in and buying this. If it gets back to the 10-day high, we're not allowed to be surprised. And so that forms the basis of the logic behind the 5-day down pattern. It has, on any given year or 3-month period, you're not surprised if it has a 60 to 65% win rate and has a payoff rate of 1.5 or 2 to 1 um, and so on. And that's typical of some of these other patterns too. Now, the overreaction and the channeling are even simpler, and I'm not going to cover those now, but those tend to be trying to hit singles, where you're trying to make, there's like the channeling has a bull market, it's pulled back below the 10-day low, or is oversold on 10-day Williams percent R, and so you're just buying the dip automatically, and then off it goes. So that has anywhere from a 65 to 75% win rate in bull markets, which is the only time you can. It's the only time that lets you play that trade, because it has a filter for bull markets only. Well, the continuation pattern on these is such that what we learned was that, like on channeling, sometimes that thing will just keep going, and all we were ever getting was that first move. And we said, "Oh man, if you have a winning trade on any one of those six, and it pulls back to the point where you exit, but it never violates the original stop loss that we had in place." So when this thing first started, there was a small risk box in here, and that became like the failure line, right? So if that if that thing goes up and it comes back, and then our standard exit gets us out of it here, and then maybe price continues lower, but then we get a universal entry, like a 1-2 entry, the continuation pattern allows us to re-enter that according to some rules, as long as the original stop loss was never violated. Because the idea is that there was a signal in this pattern which said there's still reason for that thing to go up, and then we actually cashed a winning trade, so that reinforces the original signal. So if we get a chance to keep re-entering this or adding positions, we will, because until that first stop loss is hit, then all the information is showing that the trend is still good. So what we did was we learned that continuation pattern actually applies to all of the mechanical systems. So it's a legitimate strategy now as a swing trader to take a look just at the continuation systems, and then decide if you want to play the continuation patterns as an additional. And then one of the things that we learned after doing this a lot, we said there's enough signals there that how do we pick one signal over the other? Why? What should we use to prefer one system over another? And so what we learned was, let me try to erase this. Give a man some drawing room here. So the thing that we learned next was that you could have, let's say, 3 different swing trade patterns that all gave you a signal, and maybe you have enough capital that you only want to trade one of them. How should I prefer those? So what we did was we then added a risk-reward ratio, and what we said was there was some bar down here that was the setup bar, and so we decided if we put a standard risk box around that bar, and then we looked at a standard 10-day high as the target, we could now compare the size of the risk to the size of the potential gain if it just went back to the 10-day, and then we could get our reward to risk ratio. And then on the basis of ranking these 3 choices, whichever one had the most favorable reward to risk, we might pick that, because the swing patterns tend to have reasonably similar success rates, and um, this was a way to distinguish it. Well, after doing that for about 3 or 4 years, we said, "Holy mackerel!" We started looking at charts, and we said, just on the basis of trade location alone, even without a swing trade pattern, we said the yesterday's bar was a really tight range compression in a doji, and the 10-day high was way up here, and there was some support level below it, way down there. And we said, even though there's no swing trade pattern, if we just put a risk box around that using the daily range, it turns out that there was a favorable trade in both directions. You said, yeah, but there's no pattern. Well, what we learned was that location itself, once that thing starts moving, you're going to manage all of those trades in a standard way based on getting your risk out. So as long as it's moving and you get in, if it breaks out above the high and you got long, as long as it's moving, does there need to be, or did there need to be a pattern over here before? No. So from that idea came some of these standard fractal patterns, like the auto framer, in which we simply evaluate all our symbols in our tactical trading set every day on the basis of using the daily range as a risk, the move to the 10-day high as the standard reward, and we're simply using in the auto framer, looking at those reward to risk ratios, and we want the ones in general that are higher. And in fact, when you take a look at our daily report, that reward to risk ratio itself is the primary sort mechanism. That's the default mechanism that allows us to look for the most favorable trades. Because what we've learned is that, we're not the only people that can see reward to risk, and that if something that is at a favorable reward to risk starts moving, then other people saw it too, and all we're doing is riding that trend all the way back up. Now, what's better is if you get a symbol that you trade a lot, that you specialize in, that has one of these swing patterns on them, one of the 6 that I just described, and it has a really favorable reward to risk. Well, that's 2 separate reasons to really love that swing trade. So that's what we mean by mechanical systems, continuation plays, and I would add the auto framer in there. Now, here's a third way that we might get into swing trades, and that is that we have a day trade that just won't lose. And, all during the day, that thing is just going, and we know that by the end of the day, when the end of the day traders come in here, they're going to look and say, holy cow, that symbol really smashed it today. Maybe there's more continuation tomorrow, and maybe they want to get on that hot ticket. So sometimes it's in our advantage, usually when it's in a bull market, not bear like it is lately, that at a place where we might normally get out of that, we got in here and it moved up, and so we want to liquidate our position before the end of the day so that we don't have any overnight risk, we might just decide, hey, let me keep about 20%. Let me keep about 20% of that position, and I can use the money that I gained on the way up with the day trade to fund the 1/5 of the position size with overnight risk. So now I can have a wider stop to accommodate overnight risk, and I can use markets money to pay for the risk, and I've reduced risk, and now I've exposed myself to some potential continuation patterns. So that's what we mean by growing the day trade, is that when we look at all, before the end of the day, we look at it as, is this, a swing trader would love to be in this, so maybe I will use some kind of position sizing math, like keeping 20% of the position, cashing 80% to make bank and to reduce my risk. And that's what we mean by growing day trades. So you could find some of these day trades moving into the swing area simply for that reason. It's like it jumps over the wall, right? If you start doing that a lot, what you really have done is you've performed hybrid trading, in that you are using a combination of two of these different time frames, and you're using information, in this case from the day trade, you're using information from the day trade to justify a swing trade. Well, that can actually work the other way too, and that is if you had a swing trade pattern like the 5DD, and that thing was, we know that when the 5DD works, it's going to have 3 to 5 days of strong movement in our favor. Well, if that's the case, you could then dial down, you could take a swing trade pattern, you could dial down into the time frame of the intraday. And if you saw some of our statistical patterns that were unfolding, you could actually trade that swing trade in the direction it wants to go, and use, now you're getting the energy of the swing trade helping you move, plus reinforcement from the day traders, and we call that turbo trading. And so in this case, you're taking the idea of a swing trade, that information which says this thing has a better than normal chance of making a strong directional move in the next 3 to 5 days, and now you're jumping over the fence and going into day trading, where you can have a larger risk because the size of your risk box is small, because you're trading a liquid instrument and it doesn't have overnight risk for a gap. So you can actually add to your swing trade with intraday trading, as long as the original swing trade hasn't hit its stop, as long as that thing is still open and valid, you can continue to day trade intraday by adding positions and taking off positions before the end of the day. And that's what we mean by turbo trading. Now you're combining swing and day trading. Now I want to just briefly say that the relationship between swing trading and day trading, with that little hybrid factor, you can see exactly the same relationship now between swing trading, let's see, hybrid, and core trading. Only now, instead of going intraday and daily charts, you might be using daily charts for your swing and weekly charts for the core. So you might have a really good swing trade, and if the thing lasts more than 10 days, you might actually just move that thing over into your core portfolio holding and pick up the stop management strategies from the core and let that thing grow into infinity. By the same token, your core trading system that is looking at relative strength leaders that you want to hold for 2 weeks or 4 weeks or 8 weeks, those things might be doing so well that when you take a look at the chart pattern, you say, oh, I recognize a standard swing trade pattern that has formed for this core position, and I can just add to the position. So now what you've done is you will have done hybrid trading between the core and the swing, between the swing and the core, in the same way that you did day and swing. When you put all three of those things together, you could be hybrid trading across all of the time frames on standard symbols, and you get a very efficient use of your time because you now are appreciating how that thing is working in multiple time frames, and now you can really develop some expertise with your standard set of instruments, and this becomes a very efficient use of your time. So, Geraldine, as you start going through that swing trading course, you're going to see all of those ideas expressed again, and you'll get a chance to see which of those resonate with you. The final thing that I want to say is that we have, during the COVID era, the last almost 3 years now, certainly 2 years for sure, during the last 2 years, that we've developed some standard fractal patterns that are like the RLCO patterns, regression line crossover patterns. The first generation identified patterns 1 through 7, and we named all of those in the first generation, like the P1, the breakout from the river some of those things. And what we typically use those now for, although they are tradable, is that we use those as a language to help us recognize the conditions that the market is in. So we think of that as the first generation. The second generation of RLCO is where we have identified even better patterns inside that same framework, like the owl, the supported spring crossing, the Kata 2 continuation pattern, the collapsing dragon, the emerging dragon. And those have very particular meanings, and you will see that when we day trade, we are really using those a lot. Oh, there's also the pinches, like the Z3 pinch and the super pinch. When the volatility has become exaggeratedly tight, abnormally compressed, the super pinch and the Z3 pinch give us particular ways to trade that. Otherwise, these other 5 patterns, they use the RLCO framework, but they have very particular meanings that we're looking for our setups. And those things can all be traded on 1 minute, 3 minute, 5 minute, 10 minute, 30 minute, 60 minute, 2 hour. Oh, it also turns out that they're fractal and they can be used on daily, weekly. Oh, you can even fit a 3-day in the middle of that, 9-day, monthly charts. It turns out that these patterns are fractal in nature because they represent important moments in trading psychology for each of those different time frames. So if you have core, swing, and day traders with various, and maybe core traders are looking at quarterly or monthly or weekly, and swing traders might be looking at weekly, 3-day, daily, or hourly charts, and the intraday traders are all looking at different time frames. What we have to remember is that each time frame is typically looking at their favorite chart, the way it's set up, with a timeline that is very specific to them, and they're watching price action move on their screen, and when their patterns hit, like, that guy's pattern hit, he sees it, and now he acts. Well, what we got to remember is that all of these market participants all have some price level at which they are likely to take action. So we've got to remember that we're not the only people looking at our charts, and that other people are allowed to have other ideas. So don't be surprised when somebody else acts differently than you might act. And you have to allow them permission to do that, right? So what we found is that these second generation RLCO, or what we are calling sniper patterns, these things are powerful because they work on every time frame. And as we start looking at the swing patterns that we see tonight, we're looking through the lens of these patterns because they are actionable on every time frame. And when we look at Ken H's beautiful charts here in a little bit, he's actually going to array the same symbol that he likes because it came out of one of our signal generators. He's going to take a look at a weekly chart, a daily chart, and then either a 60-minute or a 30-minute chart, so that he's getting 3 distinct time frames. One of them is like a very slow day trade, the 30 or 60, which could also be a very fast swing trade. He's looking at daily charts because so many people do, and he's looking at weekly charts in order to really appreciate the long-term time frame. So on a single chart array, we're taking a look at location and volatility. Is the price pattern pinch, and we're looking at support and resistance. And we're looking for things like our RLCO patterns of either generation, and we're going to use standard reward to risk ratios as we go through and mark up these charts. And so there's a lot of stuff going on as we start navigating through these things, and we'll we may go through that case study and how we frame it pretty fast, but I want you to know that there is an underlying set of theories and practices that really track back to core trading, swing trading, and day trading as standalone time frames, but also we've integrated hybrid trading that allows us to link those, and we're going to use this standard trading language and all these standard patterns as we start framing these trades. So you'll see us do this on the weekly, daily, and then either the 30 or the 60-minute trades for the weekends on Saturdays. And this takes kind of the same form during the daily strategy reports, except we're really looking at day charts and probably 3-minute charts primarily in order to understand the daily opportunities that are there. Now there are still some swing trades that can be going on, but the Monday through Friday stuff we're really looking at mostly the day trades because we got professional traders that are looking to go to the market every day with no overnight risk and try to pull buckets of money out of that in order to fund their ongoing operations. So the thing to know is that the standard lenses that we use, the standard setups and the patterns are the same whether we're talking purely swing trade, purely day trade, or if we're incorporating some combination of hybrid trading that uses both of them. So that's what I want to say in terms of background, and let me check to see if there's any questions on that before I drive on to the regular charts. And appreciate you allowing me to take the time to say that, and appreciate the folks in the room letting me run amok on that a little bit. It probably doesn't do us any harm to revisit that set of ideas, those top level strategic ideas periodically. So let me stand by for your comments. And Geraldine, when we say check or hold, what we that's a term from infantry mortar tactics. That check means I understand what you said, got it, move to the next computation, or hold, I need you to tell me more. I use that with my soccer players too. The little kids understand. They love that. They think it's funny. So I give them some instructions for a drill that we're going to run. And I'll say check or hold. They check, coach, we got it. Or hold, need you to tell me more, coach. So that's what I wanted to say about that. Whoever's name in there is trader. Who is that? What's your personal name so I know who I'm talking to? I think I know who it is, but I just want to double check so I know who's in here listening. Chin Long, so good. Yeah, now, Dan Blum, I know you also just started, I think, if I remember, looking at the swing trading as well. So, and I know Chin Long is interested in the swing trading. So it may very well be, and I would recommend it, that the new folks that are starting the swing trades or folks that want to really emphasize that, it might be worth your while to have an accountability group where you can start, maybe progress through the lessons and talk with each other and maybe answer each other's questions or get different perspectives and start building up some of the support network that we know is important because trading can be such a lonely experience, right? All right. So that's what I want to say. So strap in. We're getting ready to, we'll shift back over to the regularly scheduled discussions. Let me get my quick sip here. And I want to say thanks to Ken H., who's in the room tonight. And thank you so much for the continuing work you do. And Chi Wing Chong, I see you here tonight. Thank you for these next couple charts. So what we're doing on these next two charts is that we're taking a look at the regression line 30 slope. So the 30 period, 30 bars in a row, we could draw a regression line, a straight line regression, that is the best fit line for those 30 bars. It summarizes that data. Now, if those bars were perfectly sideways, then the slope of the regression line would be 0 because it's perfectly flat. But this one we see has an angle because the price was generally going up. And so one of the things that we would say is that the bigger the angle of the regression line from 0, the stronger the move. And so what we can do now is, if this is the day that we're checking right here, the 0 day, and we look back over the last 30 days, and we could say, hey, the slope value of that is X. It has some angle. That's how strong it is. And then yesterday's slope would have been the last 29 days plus the 30th day yesterday, which was 31 days ago. So each day, as we add one more day, we're dropping off one day and adding one day and recomputing that line and coming up with the slope reading x plus 1, x plus 2. So what we do is we go back 180 days and we compute 180 slope values, and then we array that from maximum to minimum. We find the average slope, and then we find the standard deviation of that slope, and that gives us a range of normal. If we go +1 to -1 standard deviation, that's also known as the z-score. The z-score is a statistical measure. It tells you when today's value, if today's value is right here, you can say how strong is that compared to the average. What you could do is you could measure how many standard deviations it is away from the average, and so the z-score is the number of standard deviations away from the 0 line or the average. And so if it's +1 z-score, then that means it's exactly 1 standard deviation above average. If it was -1, it is 1 standard deviation below average. If it was 2 or 3, then that tells you again how many standard deviations away. When you take a look at a histogram, you see, because the way standard deviation is calculated, you get like a little bell curve, if only on its side, and you say two-thirds of the slope values of the last 180 days falls within ±1 standard deviation. So between the 0 line, +1 and -1, there's a third and 1/3. So that 2/3 represents normal slope. So as I'm looking at the, I could find whatever the strongest slope up was and the strongest down slope, and I put that on some kind of like a tachometer or some kind of gauge. I would see that that slope was all over the place. But if this was the average right here, then 2/3 of the data is found in this little space. So this would tell us what abnormally strong slope up is. This would tell us what abnormally weak slope would be. And we're very interested in the abnormals because that tells you something special is going on. It's either going to be abnormally down and then revert to the mean, or it's ready to fall off the edge of the world. And if it's up strong, it may become asymptotically great, or it's going to revert to the mean. So we're always prepared for large movements in either direction when we are at abnormal z-scores. So now what we do is we take that same idea, and now we're going to compare the z-scores of the slope of the 30-period regression line for these important symbols here. We have the S&P in the thick purple line because we use that as the baseline for the whole market. And then we track XLK, which is the S&P sector spider for technology, because in good times, like right here, when the market's going up, technology is quite often the engine of growth that is pulling the market north. So when times are good, it doesn't surprise us when XLK is better. So XLK is very similar to the NASDAQ, only the XLK is about 80 symbols in the S&P 500 that are in the tech sector, whereas the NASDAQ is 100 tech companies. Some of them are in the S&P, but some of them trade on the NASDAQ, right? So, and there's quite a large overlap, but the XLK companies tend to be a little more mature and longer lived, so they're more like conservative tech, and the Qs tend to be more younger, aggressive tech. So when we're trying to distinguish between what kind of tech do we want, we could actually compare the performance of XLK versus the Qs. But for purposes of this discussion, because we're looking to understand the behavior of the S&P, well, the S&P has 10 sector spiders, or depository receipts, right? So those are the 10 segments of the S&P 500. So if you took all the companies in the S&P, they all fit into one of these XL companies. So there's XLB, which is materials, XLE is all the energy companies, XLF is the finance, K is tech, and so on. So one of the things that you typically see is that, you know, the upper third of the S&P can be very strong and better than the market, and maybe the bottom third of those sectors is weak, and then the ones in the middle look a lot like the S&P. So you can actually use that kind of analysis to determine which subset of the S&P is contributing to the performance of the market, whether it's going up or down. So one of the ways that we do that is by comparing the z-score of the RL30 regression line. And the way we have this set up is that the zero line is the 180-day average of slope, and then anything north of zero means that it is stronger than it has been on average, and anything lower than zero is weaker than average. And then the boundaries of normal are between +1 and -1. So this is the range of normal behavior. And now what we notice is that all of those symbols are well below average. They're abnormally weak, and some of them are really failing hard, like energy is failing hard, and the other ones have flattened out a little bit. Well, what that tells us is that we have a broad market failure right here. Now, that's not always been the case. There was a time back in this region when energy, which had been going to the moon with an increased oil price, suddenly the oil price collapsed, and that was good for the long-term prospects of all these other companies because their energy costs were low. So even though the energy companies in the S&P were getting smashed, that was actually good news for tech, the S&P itself, finance, materials, because they could all buy their raw materials cheaper and get a better profit. So they became very successful. And then at some point, the price of oil began to rise. And then when things got 2 standard deviations better than normal, suddenly the market, which bounced out of this bearish turn, almost got back to the bull market, and then in the last 30 days has just gotten crushed. It's gone from a +2 standard deviation through +1 back to 0 to -1, and is now at a critical state, ready to fall off the edge of the earth if the current support levels don't hold. Or this could be the basis of another tactical swing trade move. My concern is that right now politically we're about 45 days away from a major U.S. election in which there will be significant differences in economic behavior policy depending who wins the House and the Senate. So there is a huge political question mark about what's going on. So, and there could also be a lot of last minute political surprises in the next 45 days. So there's a lot of sensitivity into a market that is fragile and is hovering on the edge of collapse, that you could get some crazy political news. The world's on the edge of nuclear war with Russia right now. Do you think that would have any impact potentially on the market? Yeah, sure. So there's a very real chance that this could all go all the way back to 4 sigma to the downside. If it were to break and the markets were to collapse, you could see another 20% loss in the next 2 months before the election, and that would not be surprising. That's how bad things are psychologically and in the short term tactical. So anyway, what we're noticing here is that energy is continuing to fail. The other symbols are all well below average and well below abnormal, and they are very, very vulnerable in this condition. That's what we take, and we use this chart to help us understand where the market is in terms of like business cycle or volatility cycle. Check or hold on that? Everybody cool? I'm probably going to have to add this lesson to the swing trade course. It sounded pretty smart in my head. Yeah. All right. So now the next thing that we do is we're going to use the same concept, only now we're going to compare XLY, which is one of those sectors. That is the consumer discretionary. So when times are good, people are buying boats and second homes and all that. They're buying Teslas, which is in XLY. And XLP represents consumer staples. So at a primitive level, one of the things you can do is you can say, when XLP is better than XLY, then people are concentrating on defensive plays and they are reducing their expenditures on discretionary. But for long periods of time, like right now, XLY can be better than XLP, and some of those more aggressive companies are doing better than the staples. This is actually a really bad sign for the market, because when the defensive consumer staples are doing worse than the broader market and the market is in bear condition, that tells you this is really abnormal psychology, because normally when the market is getting smashed, people will leave the discretionary ones and go put their money in things like Colgate, Palmolive, and McDonald's, and Walmart, and home, AT&T, or conservative companies. But that's not the case right now. So this is just more evidence that the market is very fragile. So we check in like this every week just to kind of see where the sectors are, to get another view of the market conditions. Now, I would also say that the Friday night report that we record and produce is an important marker, because we took Monday, Tuesday, Wednesday, Thursday, and Friday's trade, and we summarize those little day trades. And we prepare the day trading report for Monday is included in Friday. But we also add a swing and a core set of reports and tables to carry us for the entire week ahead. Like each of the daily reports is good for one day and setting us up for tomorrow's trade, but the things that we add for the swing and the core are really to carry us forward for the whole week. So what you're going to want to do, I believe, if you're a swing trader, is make sure you listen to the Friday report, which is the closeout of all the dailies. Plus, it sets you up for some of the longer term ideas that will last all week. Then you can come in on Saturday and, for example, take a look at these charts from Chi Wing Chong, and then the ones I'm going to show you on Ken H. Now, what I'm going to also tell you, since there are a lot of swing traders in this room, as soon as you're ready, I want you to start posting one swing trade chart a week that marks up a trade that you want to set up for the next week based on your reading and understanding of the weekend reports plus your understanding of the patterns, so that we can mark up your chart with some feedback and give you insights on how you're doing with trading or setting up the trade frames. And that will also give all of us an opportunity to look at what are probably going to be pretty good patterns. And it gives us all a chance to improve our preparation by looking at more diverse charts. Now, what I'm going to tell you is that Ken H's charts are plenty good for the week ahead, and so you should be learning from his approach. But what you're going to want to do is become self-sufficient on this and learn to master the material by offering your trade charts one a week, doing your best work, and then we'll give you feedback on that, and that will improve your trading practice. So here we go with Ken H's charts. Let me increase the size here a little bit. All right, so this is the Qs, the NASDAQ 100. And he's got the weekly, daily, and he's using a 65-minute chart, which is like an hourly chart, but it evenly divides the 8.5 or 7.5 hours of the trading day into 65-minute chunks equally. So it's a bit of a mathematical workaround. So here's what we're going to notice. Now, what we're doing here is what we would call the multi-time frame, multi-lens analysis, MTF-MLA. So we're using multiple time frames. So we're looking at weekly, daily, and hourly. And we're using a multi-lens analysis, meaning that we're looking at the market through some different concepts. We're using the RLCO framework. We're using support and resistance. We're looking at volatility. We're looking at, let's see what else we're looking at. We're probably using the sniper lens too. So we're using a variety of insights to give us different points of view. Now you notice that Ken H trades this a lot. So the way he's got this marked up is that whenever he's buying, he's got green dots. In that case, he had a red dot. He was short here at 305 because it had peaked and gave him a 1, 2, 3 entry. And it also set up a short on a shorter time frame. And so he used this as a risk box. So he was short at 305 with a $5 risk to the top of the dragon. So that's his risk box, and he's short here, and that thing just got crushed and comes down to here, and that's where he covers. He covers at about 275. So he's got a trade from 305 to 275, which is a $30 gain on a $5 risk. So that's a 6R swing trade. And the gains he has is marked off by this green box. Now, I don't know if he stopped and reversed. It looks like he did. He used this as a stop and reverse. Well, why did he do that? Because on the hourly chart there was a supported spring crossing, and he used an intraday risk box, and the position started working, and he kept 20% of that for his first position, and then he got a second position on before it even got out of the dragon, and then this thing went through the PSAR and came back down, and he took his exit here. So this trade frame is an example of a hybrid trade that was incorporating the day trade plus the swing trade into a pleasing fashion. Now, he was probably trading that on the hourly, but because he's using TC2000, it'll show you where your symbols are as you go through these different these different time frames. So in this trade sequence, he was long, had a second position, cashed. He got long again, cashed that one. He got long here. He tried to get short, lost this, stopped in reverse, crushed this one. Tried to short, had a micro loss, got short here, big win. He got long, big win and a small loss. He got short here and here, both of these, and has written. The yellow dot means he was considering to add to the position, but he already had 2 in hand, and he felt like that was enough. And when he looked over here, he saw that would be a normal place for this thing to find support. So he didn't want to have 3 units of risk at a point where it was likely to turn. So he was content just managing the 2 positions well in hand, and it continued to smash all the way down. Here he thought about adding, and he did add another position. That's this one. So he's got 3 positions in hand, and this thing still no end in sight. So if we assume he has something like a $5 risk on this, he got short at 30, let's call it 300, and at 290, and at 275. So the trade from 300, and this is all priced in right now at about 265. So he's got $35 in hand on the first position, which is a 7R trade. He's got from 290 to 265 is 25. He's got 5R in hand on this one, and this one has about 1R. So he's holding on this swing trade about a 13R win. And then we notice that on the weekly, this is at a weekly critical state. So if this fails, look out below, because all of this stuff has been negated. It's fallen from 405, but all we can see is more pain and suffering ahead. So if this fails that weekly support, which is the combination of this and this thing is going to collapse, and he's got 3 positions in hand with a 13R win. And now he can use the market's money that he earned on those 2 initial positions to fund the 3rd position, and then also to maybe add if this thing starts to collapse further. Now, when you take that into the hourly chart, this is where he had the 2 positions long, and he exited that for a small win, because the minor loss on this one was paid for by the large win on this one, so he netted this much. And then this became a stop and reverse. Now this is a collapsing dragon pattern, so he gets short when the dragon, which is right here, collapses. So he gets this one. This one was also a potential collapsing dragon, but for the reasons I just said, he didn't take it, and then it collapsed further. On this one, when this dragon collapsed, he got short. He had to suffer a little bit of a retracement, but that thing has worked in his favor, and now what he set up, this yellow box, is another critical state where if it comes out of this, he should cash that right here at about 271. But if it goes below 266, he should add a position. So what you can see us doing right here is a continuation pattern based on support and resistance, well-known statistical patterns, and the way to interpret all of these patterns on the hourly chart is exactly the same interpretation on the daily as on the weekly. So one of the standard pieces of work that we have is to use fractal patterns based on statistics that give us identical interpretation no matter what time frame we're on, so that we don't have to learn a lot of arbitrary rules that vary between systems. We can use the same interpretive scheme to understand what's going on in the market and make our decisions consistently on the basis of the chart patterns that we're seeing. And this simplifies our life when we're bouncing around between different time frames altogether. So that's a standard feature. So bottom line, he's got a great trade in hand, about 13. I don't normally go this far in depth in it. I just notice, here's a 0 state, critical state, meaning he's ready to go long. In other words, cash the wins. And when he gets out, he's all out. He increments in, but when this thing breaks, all out. And then if it breaks below 266, he's short again. Now, what he's done on the time frames here, so you can see this again, is that he's built out a 5-day look back. That's 5 days of 65-minute bars. That is the same box that you see here, only this is scaled for the daily chart. And then we use a 10-day look back. And now you'll notice that the 5-day and the 10-day low, which was achieved on Friday, is the same. And then he has a 30-day look back on this one, because that really comprises the swing trade look back period of interest. This is the one that we use, like the 30 period regression line slope is computed from the 30 days of that look back, and you can see why that slope is so bad, because that's horrible. But 30 days earlier than that, that slope looked like this. So here's what you see in a matter of 60 days. If we had this on like a driving dashboard, 30 days ago, that upward slope was incredibly steep. It may have been the best 30 days in 5 years. But now, a mere 30 days later, this thing is horrible. So now it's reading down here. And now what we can do is we can see where those little markers are. And as that slope starts getting worse, our interpretation of what's going on in the market changes as that slope function changes. So what we'd have seen is that 30 days ago the slope looked like this, and then it started looking like this as it got shorter and shorter and shorter and started rolling over, and now it's pointing way down. So that z-score allows us to watch that in a very smooth instrument that looks like, something you'd see on your dashboard. So that's what we mean by the 30-period slope line. That is so important to our understanding and interpretation of the market that I'm spending this time to talk you through it, because it is maybe one of the 3 or 5 most foundational ideas that we have that applies to every time frame and is an important part of our risk management strategy. So that's the cues. Good chart, good frame. All right, this is Adobe Systems. Now, Adobe Systems, let's just walk through. Now we're going to go more at a normal speed. So here's where the weekly dragon cracked. At 360, when that cracked, it went to 275. That's the cracking sound of the market. It featured a great big gap. When that thing gapped well below those 2 support levels, that means you can discount all of this previous price action. It's now all about the pain and suffering. And it went from 330 that day to 310, gap, and now it's come all the way to 275. That's what happens when dragons collapse. And that's why the collapsing dragon, the CD, is our #1 favorite pattern. Because when you can identify a support level and it breaks, you have fear and panic in the market, and that creates large directional moves that we can exploit. And now it also turns out that might have been a good support level, because the 2 previous times it did this and it did that, and those are tradable. But when it breaks, look out below collapsing dragon. So this is what that gap looks like. This gap here is that gap there. And this sell-off here is that sell-off there. And this is where the intraday dragon collapse occurred, so he gets short here. And now this thing is well positioned. And if it breaks below 275, there's nothing on the daily chart over here. There's no support over there, and there's no support on the weekly chart. So that thing, if it breaks, is in free fall, and it just might have those kinds of moves because that's what it does when it's in free fall. This was a result of horrible earnings. So this thing is like, we're like hyenas on this one, picking over the carcass, but there's a lot of downward move still left in that one, and he's got 1 position in hand. And if I'm him, I have my stop like right above 280, right above the hump of that dragon, because what I want to do is I want to take my initial stop, which was right here, and I want to make sure that I bring it down to here so that I can lock in that much gain no matter what. So even if it reverses and I get out here, I've made that little risk box, which is a 1R trade, assuming that that's the size of his risk box. Check or hold. And if you just put the letter C in there, then I'll know that you guys got it. Okay. So nice one. Next one. Now, where does Ken H get all of these symbols? Well, there's a couple things that you can do. You can go to tortoisecapital.net and listen to his annual research weekend report from last year, from last December, where he goes through his entire psychological and technical journey to mastery, and he talks about where he gets his symbols. But he's taken them from the daily and the weekend report on his favored patterns that have great reward to risk ratios or sniper trade patterns. Maybe if he's shy by nature, maybe we'll get him to talk about that this year again. Plus, he owes us a trade histogram at some point, and we want to see the good work he's doing because he's frankly staggering. Now, what he's got here is Twitter. So, Twitter's of interest to us because Elon might have to buy this thing around 40. So all of these gyrations are coming from Twitter in the news with Elon Musk. So this thing is abnormally volatile, even for a tech company. And we can see that there was a period of congestion here and here, and it has broken out. But it's right at a at a critical state around 45. That's what Elon was going to buy it for. And Twitter isn't making any money. So it's hard to see why anybody would pay more than $45 for it when Elon's bid at 44 was already 20% over fair market value. So I'm just a caveman, but I would not be surprised if this little run-up in a bear market didn't collapse. And if this collapses out of this critical state, then a move to support at 42.50 would not be unusual. So that would be a move from 44 to 42.50. That's a move, that's a reward of $1.50, and his risk box is 50 cents. So that gives him a favorable 3-to-1 reward to risk. Just if this box breaks and it moves down to support, you're not allowed to be surprised if that's the case. It's just moving to support. The last time it moved to support, it rebounded. So if it went all the way down here and then started to reverse, you get out of the trade because you got what you were entitled to expect, and that was a 3-to-1, 1, 2, 3-to-1 reward to risk out of this risk box. But if this breaks out, it looks like he's ready to buy that, because if this breaks, well then it will have closed this whole gap, and then the next price level is up around 50 or 49. There's another $4 to the upside. So if he's risking 50 cents, if this breaks out, there's an 8-to-1 reward to risk to the upside. So what we've done here is we've constructed a minimum manageable risk box, meaning that the size of the risk, where we don't have a directional bias, I'm in the zero state, so I'm prepared to trade it long or short. I do not care, and I don't have an opinion. My only opinion is that I believe that I'm going to trade this. So what we call the space between those is the yellow zone, in which it does not have a directional bias. And if it breaks out of this, then we would be long here at 44.25 with the idea that it could very easily get to 49. But if it broke below here, we'd be short because we believe it could get to 42.50 easily. Either one of those is not a surprising move. Look how far and how fast this thing moves when that little a consolidation breaks, it went that far already. When this broke out, it went that far in one move. So that's why we consider this a important critical state. So that's Twitter. That's enough about that. Standard work. This is Verizon. This has been getting absolutely slaughtered. It's a Godzilla pattern, meaning that it's near its 150-day low, 30-day low, and 10-day low, has extraordinary volatility. So if it breaks down from here, you wouldn't be surprised if it dropped another $5. Every time it collapses, it moves $5. So if this doesn't hold, it could get to 33 in a heartbeat. But if it holds and it rolls up, then it could have a move like that, which is a $2 move. So $2 from that could get to 40, and you only got a 25-cent risk box. So this is what we think of as a compound critical state, ready to go large in either direction with a minimum manageable risk box. This is a case where I would only day trade this because the daily patterns are so bad, there's no indication at all that it's ready to rebound. It's not until price gets through the PSAR that I have any justification for thinking that this thing could go up. So it has to get through, let's call it 40, before we would even think about a swing trade. But the intraday trade is certainly interesting. Now, if it breaks to the downside, you could initiate a swing trade there, although I would wish that on this collapsing dragon we'd have had a short from 44, or on this collapsing dragon short from 41. But I would also get short here, although I would have wished that I had those. So this is a Verizon in a compound critical state that comes off of the Godzilla setup report. Here's Clearfield Inc. Technology sectors, communication equipment. Completely different vibe on this one, isn't it? Yeah, it had a nice run up, a pullback, consolidation. It broke out, and now at the test, this is where it's supposed to roll over, just like it did here, but it didn't. It broke out, and that's the unleashing of the hounds. That's this whole move. And you're in that move on the breakout from the PSAR break. That's a supportive spring crossing. This is a COTA 2 entry. That's a COTA 2. That's a COTA 2. So each one of these was a place to get an additional entry in, and you're in the whole way because of the adaptive PSAR. You get that whole move. But this is a collapsing dragon, short. This is a collapsing dragon, and now we're in the chop on the daily, and we had one breakout here. So now let's zoom in and take a look at what's going on the 65 minute. Well, if this doesn't break out higher, then this looks like an irrational move, and then the move is probably back into here about 92. Maybe as high as maybe 98 if this were to act as resistance. So there's at least a $6 move on a $2 risk. That's 3 to 1. And then the breakout, because that is not resistance, that's just gap. The first move to the upside where you see resistance is 118. So that is a $10 move on a $2 risk. That's a 5 to 1 move on the upside. So this is a perfect critical state. This is what we would call a popcorn or a fireworks move. This is fireworks because the 5-day volatility is so large. This is like this created a sonic boom. Is it going to work? It might continue all the way up, or it might fall to earth like there's nobody left to buy. So that makes this a compound critical state ready to go large in either direction. Next up, Tesla, the most important stock in the world. And we're just going to understand some things on this one. So here was a weekly consolidation level between 260 and 220. So that is this entire block is what that one looks like, right? Because here's that 220 support level, 220 to 260. You can't even see that one over on this one except for that last little trigger piece right here. That's this. That is this. And then, so this held as a support, or at this resistance. When that resistance broke, it did this. And then there was this series of higher lows. So these all became kata 2s to the upside until the dragons started collapsing. And then when all of these collapse, and here's another one, when this all collapses, you get this powerful sell-off. Now this could only get to the support or the resistance level and then failed. It tried it twice and then failed big time. And now it's all the way back down to 260 right here. Now, if this region does not hold support, it will come down to 230, which is the midpoint. That's the mean of this previous support level. So I target 230 as the middle of that resistance zone. So if this breaks and it's at 264, that means there's about a $35 move to the downside, which means that I could afford a $10 risk and still have 3 to 1. And that's probably, I could use a $5 risk and have 7 to 1. So that what that tells you is the downside trade is more than justified. The upside trade from here, it has to get through 274. So that's not much to play for. But if it does break out, and if the market is good and Tesla's better, so here's the way I set up that scenario. Because Tesla's so big that its momentum will attract more buyers, I don't just limit myself to this first move, but I also look at 280, 290, and then it could go all the way. So what I would do is I'm going to watch to see what direction is the S&P going, what direction is XLK and the Qs going, how is tech doing in general. And then if Tesla, in a perfect world for the upside trade, the S&P is up and recovering from disaster, and tech is better, and Tesla is the best of all, in which case Tesla would be my primary upside play because it is it inspires the most confidence, and there's going to be a lot of people that wish they owned Tesla, and here's a chance to buy it on sale at 265. Remember, somebody bought this thing at 310. So you actually have a 10% fire sale on Tesla, and so this momentum as it starts moving up could build the narrative as you go. So I'm ready to trade Tesla in either direction out of that critical state on that basis. Critical state because it's at key support. Check or hold. So I want you to notice what we're doing here is that I'm relying more on trade location and volatility and standard patterns and risk reward to evaluate these opportunities. There was a lot of signal generators, I'm going to call that SG, signal generators that nominated this list of symbols for Ken to consider. So I know that all of these are sound, good signal generators to take a look at good charts, but now what I'm doing is I'm evaluating them on the merits that I see on the basis of the trade lenses that we use. Okay. XBI is biotech, and it was the worst sector last week, and NDAX was the worst component of that sector, and you can see why. So this thing is just horrible. He's got one swing trade in position from here. He's ready to add a second position short. He's ready to cover it at 19. This is in great shape. Good Lord, that's about a, if you're intraday, that's about a 5 to 10 hour win. And the swing trade is pretty nice here. He probably had a 3-day high, something like that. So he's holding 1 or 2 hour. But this one is just good to go. There is no resistance or no support anywhere in sight. So if this fails, and these guys are getting close to going out of business because if you look at his long term, at one point this year it was at 240 and now it's at 18. Uh, that's a 95% loss. So if that collapses further, nobody believes in that company anymore, and you're just picking over the bones. But this is, I would continue. Hey, here's how good that is. He's short at 24, and it's at 18. That's a minus 25% loss in the share price. That's brutal. And there's no end in sight until it goes to zero. So, good one. He used that as a hybrid trade where he was looking at sectors and then finding the worst component. That's a great idea. Devon Energy, one of our standard patterns. Love Devon Energy. I traded that all week. On the way up, this thing behaves well with COTA 2s. The sell off, and then you got a COTA 2 here, a breakout, and now it's coming down. It wants to test 50. 50 is the rock solid support. And now the peak was 75. This one didn't hold, so there's your collapsing dragon. If it goes below 56, this is an auto short, but it's had a nice bounce to 62. This was his long effort. It was a micro loss, stop and reverse, all the way down. He should have exited right here. Yes, you should have. But what he's going to do is now exit at 62 for that short, because if it breaks above 62, he's going to be long. So why would you be short when you want to be long? But if it goes below 60, you could actually get a second position on and try to trade it back to 55 because energy has been so weak. So, critical state, don't let it get north of 62. Add a position if it goes 59. Because it had a chance to go and it didn't. So if it fails, go ahead, put a second position on, and then respect your exits. This is CRK, Comstock Resources, energy sector. And this one's going to look very similar. Here's that little one-day bounce, and here's his critical state. So the short play goes to 15. If it breaks to the upside, you think it's going to get to 19. So that gives you $1.50 upside risk for a 20-cent. That's a 7-to-1 in either direction. Love it. And this thing trades like a maniac on the daily. Look at that volatility. If you're a trader, you love volatility. You have to have it to make money. This is Nucor. This is part of the steel complex, and he is crushing this on the daily. This is the SSC, standard work, standard exit, collapsing dragon, one position, two position. Thought about a third one. He's holding a nice, that's his two short positions, holding an excellent trade. His stop's at 110. He adds another position, but goes below 102. Great shape. And why would you want to add another position? Oh, because even on the long term, this is crucial support levels. If those break, if that breaks, this thing collapses. Alcoa, another one of our old reliables. This was a horrible earnings. He's now at long-term, multi-year support around 33. This is down from 95. That's a minus 65%. Ouch. He took advantage of the long sides. He got short here in the collapsing dragon. He cashed. He missed this re-entry here, but that's pretty good. Now he's holding a risk box of about that in my judgment, so he's holding about 2R. If this breaks, you want a second position short. If it breaks above 35, cash it. In every case, a bird in the hand is worth two in the bush. NVAX, Oh, I'm sorry. I opened that twice. All right. We've seen that one already. And Ford. So Ford had a $1 billion profit warning. That was, I think that was this gap here, and he got short, and a second one, and now it's testing key support levels here. If this breaks, you could start a position here because of the collapsing dragon. So if this little wrist box here breaks, you could be short immediately, but then he's got to stop at 1175. So let's take a look at this one that started off intraday and he's grown into a swing. He probably had a 50-cent risk box on this, and he's short from 1350, and it's at 11 and a quarter. Two and a quarter divided by 50 cents. This first one is 4.5 R in hand. This one from 13 to that's about 3R. So he's holding about 7R in hand, and he's going to add another position with markets money if that collapses. Standard work. International paper. This was a sniper trade. This was a particular pattern. It was the Godzilla pattern over here at 41, and it's done nothing but collapse to the downside. He gets a collapsing dragon here, short from 34 on probably about a $2 risk, and he's got about 1.5R in hand on the swing trade. This one is easier to trade on the dailies, because you see it doesn't always have a lot of volume on the intraday, so you could probably take your marching orders off of the daily chart. But he's got a good stop locked in at 33, and if this breaks, he should add a position to the downside, paid for with markets money. So he's going to increment in. That's a great trade. It comes right out of the Godzilla report on the sniper for sniper trading. Last one, Levi Strauss, consumer staples and retail. You can see that the long-term weekly support levels collapsed at 1650, and now it's in free fall. So when those collapsing dragons collapse, you got to be short right there at 16. So when this collapsing dragon hits, anywhere in here, you can be short with a stop at the top of the dragon or the PSAR flip. So you're only risking 25 cents. This thing is collapsed to here. It's in free fall, so if it goes below 1445, you can pile on. There's no support anywhere in sight. Where's the support? Nowhere. That's how bad things are. All right, so we went a little bit longer than normal, but this gives you some appreciation for some of the underlying concepts that we typically just kind of blaze our way through. Periodically, it's good to revisit these. So I'll get this added to the swing trade course, and it probably would benefit you to listen carefully to the lecture on how we set up the charts and why. That's about 50 minutes. And then listen to the front 30 minutes of this that talked about the broad approach to strategy, so you can see how we try to integrate these different time frames into a standard approach to trading, to get our trader's mind right. A trader's mind must be concerned exclusively with price and volatility, location and volatility, and be ego-free, don't have a directional bias, frame trades in both directions, follow the price. You don't have to be right. You just can't stay wrong too long. So we've got to have that kind of flexibility of mind. Okay? So take good care. And the Creativity 202 guys, we shall see you tomorrow morning at 10 for a very good session. The one tomorrow, just to give you a heads up on that. Um, if you're in the sound of my voice, you should strongly consider taking that course. I'm just telling you. It will benefit you in ways you cannot begin to believe. The session tomorrow is the 15th lesson in the 30 out of 30. And it's about neutralizing hopes and fears, is the title from the Fletcher, my friend Angus Fletcher's book. Neutralizing hopes and fears. I take the course myself, even though I wrote half of it, because I go through the lessons, and this is my learning journal notes for that lesson, which is part of the course now. I put all my learning journal notes. As I was going through Fletcher's readings and exercises, I was reminded of all these important celebrations of courage, that fortune favors the brave. It's not. I used this one on the soccer field this morning, by the way. It's not the size of the dog in the fight. It's the size of the fight in the dog, because I had a young kid playing on my team, and he saw the size of some of the other players, and I said, look, dude, it's not the size of the dog in the fight. You're a little guy, but you got a heart like a lion. It's the size of the fight in the dog. The British SAS, who dares wins. The French commandos, audace, audace, toujours l'audace. It's the audacity. Offense wins the wars. Defense wins championships, but you have to put points on the board. I think of St. Crispin's Day speech in Henry VIII. Patton's speech to the Third Army. How do we convert that inspiration, though, into perspiration of doing work that locks in the long-term goodness? It's fine to be inspired, but you got to turn that energy into standard practice and professional work and keep grinding it out. So it's not enough to be inspired. You have to do something about it. So on my side, these are the things that I'm going to give you, just instructions on how to get into the zero state. Make a rich description of all your senses of when you're in the zero. Imagine you're in that perfect trading state. What are all 5 of your senses recognizing? Well, I want you to make a sketch, like your brochure of the zero state. Create an icon, like a flag or a coat of arms. What is your walking in song that gets you in the right mind frame for trading? What kind of short, sharp victory cry of a sound could you use to trigger the arrival of that state? What kind of recipe do you follow to get into that state? Do you have a process? What keyword can you use as a trigger to get you there fast? So whatever you're using as your trading process analogy, make sure it's something that allows you to reliably, ritually, rapidly get into the zero state, which is a state of mind, body, and feeling that is optimized and ready to trade. And then my true storytelling notes, the ones I'll tell tomorrow, are concerned with how I use the zero state to help me take the actions I want to make. That'll be my true story contribution tomorrow at 10. So if you're in the sound of my voice, consider taking that course. There's a discounted price. If you're in the sound of my voice, I'll give you $1,000 off if you sign up for the home study course. Well over 100 hours of recorded material already. Very good stuff in there. So that's everything I got for you tonight. Take good care, and we shall see you tomorrow and tomorrow night. Take good care.